Hi, everyone. Welcome to the Week in Charts, where I run through the most interesting charts and themes in markets and investing. Another big show today, a lot to talk about. We got housing market data, historic rally in the stock market continuing, and bond yields rising, and much more. Today's show is brought to you by my friends at YCharts. YCharts is an awesome data analytics and charting platform. Take a look at the show notes for a link to get a free trial to YCharts and 20% off when you first sign up for the service. Let's start out with the housing market. And in the US, the increasingly unaffordable housing market. So we have prices on the rise. The average new home price in the US is now over 500,000 for the first time in history. So 511,000 average price. That's 25% higher in the last year. Just a stunning increase. At the same time, prices are rising. You have mortgage rates rising as well. So you have two factors working against the home buyer here. You have rising prices and rising mortgage rates. And how much have mortgage rates risen? Well, now they're up over 2% from their all-time lows last year. So 4.67%. That's over 2% higher than the all-time lows. And in the past 3 weeks, we've seen a really stunning increase, 82 basis point increase in just the past 3 weeks. And just to put that in context, we haven't seen a 3-week increase that large since May 1987. So a long, long time since we've seen a spike in mortgage rates this fast. So if we compare to early 2019, so you go back to early 2019, you have the same mortgage rate as today, around 4.6%, but you have housing prices up 42% since then. So what does that do to the affordability for the average American? Well, it's really plummeting, right? So you have a 42% increase in the monthly payment. You have a much bigger down payment now required because the housing price has gone up so much. So two big factors that are likely to weigh on the housing market in the months to come. And now the context of that is important because even before the recent increases, this is really the largest short-term increase we've seen in home prices since the housing bubble of the mid-2000s. So you already had housing prices pretty stretched relative to incomes, and now you have mortgage rates rising as well. So I think the expectation is going to be a much more difficult year for the housing market to come. So let's talk about the free money effect. And this is something we've touched on a number of times over the past few years. Everything really started with the pandemic when it first hit in March 2020. We borrowed a lot of money, we printed a lot of money, and then we saw the effect of that. And initially, the effect was pretty good. And if you look at just nominal prices, everything still looks pretty good. So this is a chart showing U.S. household net worth. And if we look at last year, 2021, we had huge increase in the stock market, huge increase in home prices. Well, those are the two biggest assets for Americans. We had an $18 trillion increase in the net worth of U.S. households, just a stunning increase. And it was the third year in a row we saw a record increase. So what's driving that? What really led to that big increase the last few years? Well, it's a huge increase, number one, in debt. So if we look at U.S. national debt, we went from 23 trillion to over 29 trillion, over $6 trillion increase in national debt in a 2-year period. And we spent that. We gave out 3 rounds of stimulus checks to various other forms of stimulus. That helped the economy. That drove up stock prices. That led to higher housing demand and so on and so forth. The other factor, of course, is the money supply. And you had a over 40% increase in the U.S. money supply. That's by far the largest 2-year increase we've ever seen in history. So if you go back and you look historically at other countries and other situations where there was such a big increase in debt and the money supply, you see a similar impact in terms of early on, everything looks good. You have rising stock prices, rising home prices, rising prosperity. You have unemployment going down. You have just a huge influx of stimulus, and it seems like it's only good. It's only with a lag that you see the actual counter effects of issuing that much debt and printing that much money. And so on that point, we got another inflation data point today. This is the PCE price index. And now we've seen the highest increase in this index since 1982. And as we've talked about, even with CPI, which is at 7.9%, this is likely understating the true rate of inflation in the US, which is likely well over 10%. So really, the psychology has changed from early on, where it was viewed as everything is good in terms of printing money and borrowing money. And today, now you have inflation outpacing the wages of Americans, and now they're starting to get concerned about that. So we'll talk about that in a little bit in terms of consumer sentiment and how it's driving that. But this free money effect, again, on paper, it looks very good because you have just a stunning increase in household wealth because the two biggest assets, the stock market and the housing market, are at record highs coming into the year. So let's talk about the US currency. Let's talk about the US dollar. The dollar, you would expect it to be going down. I think if I showed you the chart of debt and I showed you the chart of money supply, you'd say, well, the dollar is worth less, so it should be going down. But I think the big question in terms of currency is going down versus what, relative to what. So the US dollar has to be viewed against something else. We can view it against gold, we can view it against Bitcoin, or we could view it against other currencies. And that's kind of the traditional way of looking at it. So while the purchasing power of the US dollar has gone down, that same dollar is buying much less in goods. If we look at the dollar relative to other currencies around the world, the dollar's actually appreciated over the past year and quite a bit. So this is a chart showing you the US dollar index. As you can see, it's going up and to the right. And what are the two biggest components of this index? It's the dollar relative to the yen and the euro. And so despite what the US government has done and the Federal Reserve has done in terms of policies that you would have thought would lead to a decline in the dollar, and it has in terms of purchasing power, the countries in Europe and the ECB and Japan and the Bank of Japan have done similar policies to the US, in some ways even more so. So here's an interesting thing. If we look at the Japanese yen ETF, so this is a chart going back since the inception of the Japanese yen ETF, and we're at an all-time low here, down 43% versus the dollar since its peak in 2011. And you can see here on the right side of this chart just a collapse in recent weeks. And again, one might say, why is this occurring given what the Fed has done, given what the government has done? Well, if we look at the Bank of Japan, it makes the Fed actually look pretty tame in terms of what they've done in their balance sheet. Here's the Bank of Japan assets as a percent of their GDP. And as you can see, we're at 135% of GDP. Just 10 years ago, this was at roughly 20%. So just a stunning increase in the last decade. And since the pandemic, same as the US, big sharp rise and even bigger than the Fed. So by comparison, this is a chart showing you the Federal Reserve's assets as a percentage of GDP. And it's pretty high. It's at 37%. It's doubled over the past few years, but it's nowhere near the Bank of Japan. So again, that's the concept of it's all relative. The US has done a lot in terms of stimulus, but other countries have done even more. So if we look at the Eurozone, this is a chart showing the inflation rate in the Eurozone versus the short-term interest rates there, which is really controlled by the ECB. And as you can see, inflation in the Eurozone, like the US, is going pretty much straight up, 5.9%, highest we've seen in a long time there. Now, what is the European Central Bank, the ECB, doing? Nothing. So unlike the Fed, which is hiked rates now already and is expected to continue to hike at every meeting until year end, the ECB is still at negative interest rates. So we're still at negative 50 basis points on the short-term interest rate in Europe. And so a big differential there in central bank policy, and that's leading to a differential in the currencies, which is a little bit counterintuitive. But again, you have to remember the dollar is just relative to something else. So it could be measured against gold or Bitcoin, but we're looking at other currencies. You have to look at what's going on in their economies and their central banks as well. So let's talk about the divergence and what it looks like in terms of interest rates, looking at US and Japan. So if we look at US interest rates, if we look at 1 year, 2 year, 3 year, 5 year, 10 year, 30 year, all hit their highest levels since 2019. And we're seeing really a narrowing in the yield curve as well. And so what we're seeing here on the short end of the curve is really an expectation that the Fed is going to hike aggressively into year end. So if you look at the Fed funds futures, it really changes every day, but the market's expecting a significant increase into year end. We're looking at a Fed funds rate, the market implied Fed funds rate of around 2.5%. So that would be a substantial increase from today, meaning more than a hike at every meeting, if that turns out to be correct. The Fed themselves have said they're going to do one hike at every meeting through year end. Now, again, we have this differential here because the Bank of Japan, like the ECB, is at negative interest rates still in terms of their policy, with no plan on raising that anytime soon. And what that's leading to is really a big divergence in terms of interest rates in the US versus Japan. And so this chart shows you the spread between US yields and then subtracting Japanese 10-year bond yields, as you can see, going up and to the right. So a big divergence here between US policy, which is finally tightening, and the policies of the Bank of Japan and the ECB for now. So as that changes, that could change the currencies as well. So if there's an expectation that the ECB might hike soon or be more aggressive, well, you could see the euro start to rally. Same thing with the Bank of Japan. The contrary situation would be, let's say the Fed isn't as hawkish as the market is expecting. Again, you could see a reversal there in the dollar. But for now, you're seeing that spread widen because the expectation is the Fed's going to be much more hawkish than the ECB and Bank of Japan this year. So let's talk about the pain trade. There's a good saying in markets that I really like, and that's the markets tend to move in the direction that causes the most pain to the most participants. And this is known as the pain trade. So whatever's most painful in terms of sentiment, the market has a tendency to move that way. So if everyone's bearish, the market tends to move up. If everyone's bullish, the market tends to move down. This is a very, very short-term indicator, and it's kind of a generalization. But if we look at the past few weeks, I think that's what we've seen in markets. People were pretty bearish a few weeks ago. Again, I put out this poll asking what would you be more surprised with, a 10% rally or 10% sell-off? And more people said 10% rally. And if you look at any number of sentiment polls in mid-March, they were very bearish. The S&P is down 14% from its high. NASDAQ 100 is down over 20%. You had tech stocks down 50, 60, 70%. If you look at the high growth names. So sentiment was pretty bearish. It was getting worse. And people were really surprised to see, I think, what's happened here. So the pain trade was higher, and we've seen just a stunning move higher in the S&P 500 in the last 11 trading days. You have an 11% advance. And just to give you some context how rare that is, I put together a list in the last 50 years, and these are the only periods where we saw a higher percentage increase over 11 days. So not too many dates here. If you take a look at the list, you probably very quickly will jump out at you is that many of these occurred during bear markets or coming out of a bear market. So if we look at 2020, of course, that was following the pandemic crash. If we have 2011, that was a 20% decline, a bear market, and then the market came out of it. We have March 2009, obviously was the historic low for that bear market. Then you have a situation like 2008, December, that was a kind of a dead cat bounce or rally within a bear market. And so you could look down this list, many of them occurred again during bear markets or coming out of bear markets. I think a big exception would be March 2000, which actually occurred right at the peak of the dot-com bubble. So what do you take away from this? I think a lot of people usually they want to look at this and say, what were the returns following these periods? I would caution against doing that because every time is different. And this time is different in that we're not in a bear market yet in the S&P. So we haven't had a very large decline like we saw in many of these other situations just yet. So if it's different today, it'll be different again. And if we look at the US inflation rate rising versus these other periods, if we look at where the economy is, very different. So all different factors today. And so you shouldn't take what's happened in the past and say, well, something similar is going to happen today just because we saw a similar advance coming off a bottom. So it's more interesting in terms of a data point, but I wouldn't say that's actionable in the sense that you should expect to see huge gains like we saw following many of these periods in history. On that point, I think an interesting thing is if we look at today, the stock market and the bond market in the U.S. relative to their highs, and after this huge historic rally in the S&P 500, the bond market's actually down more from its high than stocks. So S&P 500, it's only a few percent away from its all-time high after this rally, while the U.S. bond market's still 8% off its high from August 2020. So something probably one wouldn't have expected, given what's going on in the news in terms of inflation fears and rising interest rates and the war. One would expect the stock market to be down more, and historically that likely would have been the case, but the market is nothing if it's not full of surprises. So we'll see how this plays out, but certainly something that I don't think a lot of people expected to see given what's gone on here. So why is the bond market down so much? We've talked about it. We showed that chart of rising yields, and we were coming off all-time lows in yields in 2020, and there was no cushion. So you had interest rates rising to where they are today. The 10 years gone from 50 basis points to 2.5%, so up 2%. And that's led to a decline in bond prices. So today the bond market's repriced. 2.5, 10 years, still not very high in a historical context, certainly not high given 7.9% inflation, but it's much better than where it was in 2020. So let's talk about the good, the bad, and the ugly, just a few different charts here. The good, let's talk about the jobs market. So the jobs market in the US continues to be strong. This is what I've called the greatest jobs comeback in history. And so in March and April in 2020, when we had the pandemic shutdowns, you had just this collapse in jobs, and 20 million private sector jobs were lost in that very short period of time. As you can see here, this is jobless claims, people filing for unemployment. We just saw a record spike in a very short period of time. And since then, it's just come down, come down, come down. And now we're at the lowest level in terms of people filing for unemployment actually since 1969. So just a stunning recovery in the job market. It's a good thing to see. We haven't seen this ever. If we adjust for population increase, this is the lowest ever. So the population in 1969 was obviously much lower than it is today. So if we take that into account, this is the lowest level ever for jobless claims. And so the number of factors pointing to that. Number one, there's just so many available jobs out there. We talk about this, but 11 million job openings in the US. That's 5 million more than the number of unemployed people in the US. So you just have this huge availability for anyone that wants a job to get it. And, that's obviously contributing to higher wages and higher benefits and so forth, wage inflation there. But in terms of availability of jobs, it's a very good thing. And I think we'll see a new high in the number of jobs very soon. So the bad, let's talk about consumer sentiment. So consumer is the most important part of the US economy. When you have a recession, the consumer obviously drives that. It's mostly psychological. Many of the times where the consumer just is feeling uncertain or uneasy about the future, they start pulling back in terms of their discretionary spending. And that leads to lower demand, and you start to see retail sales fall and manufacturing activity and so on and so forth. So here we have a chart of University of Michigan consumer sentiment, and really going back to its inception, we've never seen it this low, except one time where the U.S. hasn't been in a recession, and that one time was the 2011 bear market, where it collapsed and then it came right back. So it's an interesting data point. I think it's pretty significant that people are this worried about inflation to the point where this index has gotten to this level. And if we look at a quote from the survey, 32% said they expected their financial position to worsen in the year ahead. That's the highest level ever recorded in the history of this index. And this index survey started in the 1940s. So just some perspective how worried and how really long it's been since people have been worried that they were going to have a loss in prosperity, which is their financial position is going to worsen. And why are they worried about that? Because they're seeing month after month the increase in inflation outpace the increase in their wages. So again, that's the lagged effect, the negative consequences of that free money. They're starting to see that, and they're very concerned. So obviously, we haven't seen it yet in the data. But when we get retail sales in a few weeks, I think that'll give us the first clear data point to say, are people starting to pull back? I certainly think that the bond market's suggesting that there's going to be a slowdown in the first quarter here. Will it be worse than that? I think that depends on a lot of factors, but this is a data point that people should watch pretty closely in terms of, are people actually following through with cutting back on their spending, or are they just reporting this in the polls, saying one thing essentially, but doing another? So you do at times have that conflicting data point where people are saying they're very negative. Well, they're obviously going to the gas pump, they're feeling the pain, they're paying higher prices in the supermarket. All of these things are important factors, but are they pulling back from spending? And so I think the only saving grace for the US consumer here is that they're in a pretty good position still, because they have a lot of built up savings from that stimulus still. They don't have, if we look at credit rates, it's not very high today. So their balance sheet is in pretty good shape if we look at the US consumer. So if they want to continue spending through this for a little while, they still can. And the question is, will they want to? And at one point, will they start pushing back and say, I'm going to hold off on that purchase of a car or that electronic purchase or something else, because that price increase has just gotten to be too much? So let's talk about the ugly, and this is a tough one to swallow, and hopefully this doesn't continue for everybody. It's going to be problematic if it does. This is a chart showing fertilizer prices in North America, and as you can see, it's hit record highs, and it's doubled over the past year. This is a very important input to agriculture in terms of the cost of production and also in terms of yield. So when cost of fertilizer goes up, farmers will tend to plant less because they know that the cost is going up, and they don't want to outlay that if they're not sure they're going to be able to sell that product on the back end. So we have a situation here where it's really an expectation of supply constraints. So the largest exporter of fertilizer in the world is Russia, and they're about 13% of the market. So we talked a few weeks ago about Russia and their importance to the wheat market and corn market, and Ukraine as well. But this is another factor where the U.S. does produce a lot of its own farm products, but fertilizer is a global market like these other things, and you can't take Russia out of the equation and not to see an impact from pricing worldwide. So hopefully, again, this is something that's going to go back down pretty quickly. Otherwise, we're going to start to see much higher prices in terms of food, and which is really going to hit the developing world pretty hard, which really is dependent more on Russia and Ukraine, not only for their agriculture, but for their fertilizer imports and their own food inventories. So again, hopefully we get a resolution of the war there, and this comes back down pretty quickly. Finally, I want to end with the pandemic, new pandemic lows. Very great to see. This is something we've been talking about for months. We thought it was going to happen. It is happening now. If we look at the number of deaths globally, it's really just been plummeting. So they were at the lowest level of deaths since the pandemic began in terms of number of deaths per day globally, looking at every country. Just a big decline since what we saw in January. And importantly, like we've talked about, at every successive peak here since the beginning of 2021, we've seen a lower fatality rate. So if we take the number of deaths and we put it over the number of cases or infections, we have a much lower chance of death based on an infection for COVID. And why is that? Well, we've talked about the reasons. Number one, the vaccines have lowered the risk of hospitalization and death. And two, natural immunity, we know, is very important as well. And many people have now gotten the virus. And once you've been infected with the virus, the next time you get it, your chance of a severe outcome goes way down. So two really positive factors driving this number lower. Hopefully it continues, but it's a great thing to see. And here in the US, just a stunning chart here. This is a chart of COVID-19 hospitalizations. And as you can see, down 90% from the levels, the peak in January. And now we're actually at a new pandemic low in terms of the number of patients hospitalized with COVID in the US. So stunning reversal. The implications are huge We were already seeing travel numbers go up significantly in the last month or so coming out. And I think into the summer, hopefully we'll see that continue and people get back to their normal lives again. So just wonderful to see, and hopefully it just continues. So that's it for this week. Have a great week, everyone. Rest of the week. Have a great weekend. And we'll see you next week. Thanks for joining. Bye.